In this presentation, I show examples of basic event study methodologies. These methodologies enable us to verify the validity of the semi-strong form of the efficient markets hypothesis. Now, as a reminder, the semi-strong form of the efficient markets hypothesis argues that asset prices already fully reflect all publicly available information, and as a result, it's not possible to earn abnormal returns using either fundamental or technical analysis. So now the question here is, how do we calculate the abnormal return to determine whether in fact there has been a violation of this hypothesis? So to begin, I first show an illustration of the empirical process in determining in the calculation of abnormal returns using this event study timeline. So the focus here is on day 0, which is the day some public event has occurred. Say the announcement of a merger or divestiture, the launching of a new product, the hiring of a new chairman of the board of directors, or the firing of one for that matter. So anyhow, so on this day 0, we're going to calculate abnormal returns. And if an abnormal return occurs on this day, no biggie, because we're going to say, okay, the market is responding appropriately to the quality of that information, of that public event. However, if we continue to observe significant abnormal returns in the days that follow, say 2 days after, up to 5 days after, up to 10 days after, whatever it is that interests you, then you're going to have to start questioning the validity of the semi-strong form of the efficient markets hypothesis with respect to this particular event, because it means that abnormal returns are lingering. The market is not quickly incorporating that information in the pricing of the stock as a result. Now, as well, if we were to start observing abnormal returns prior to the event, say for example, a day or two, perhaps longer, prior to the event here, this means 2 days before. If we start to observe abnormal returns prior to day 0, the day of the event, then that's suggesting that there might have been some insider information that resulted in some investors making a killing in the market. And so what we're going to do is to calculate abnormal returns for each day or each week or each month. You choose the time period over this observation period to see if, one, there is some evidence of insider information, of insider trading going on here, and two, if the efficient markets hypothesis has been violated on account of sluggish trading of the stock, in that abnormal returns persist in the days that followed the public announcement. So now, there are 3 basic methods to calculate abnormal returns. There are more sophisticated methods, but for the purpose of this presentation, I'm just going to show these 3 basic methods. The first is the mean adjusted returns model, which simply looks at the difference between the return on a stock on a particular day, say on day 0, and the average return on the stock. The average return on the stock is what you believe to be typical. And one way to obtain this average return is to go back here, a period over which you believe nothing of significance has occurred with respect to the firm, and then calculate the rate of return on the stock and take the average of those rates of return. So this period, 100 days prior to up to 5 days before day 0, represents your estimation period. Now the researcher chooses the period. So now we calculate R bar, which is the average return. We then look at the difference between that number and the rate of return on each of the days during this observation period. If the difference is statistically significant, then you're going to have to start making some inference on regarding the validity of the efficient markets hypothesis, as well as, for that matter, insider trading if you find that to be the case prior to day zero. Now, the second is the market adjusted returns model, which looks at the difference between the return on the stock on a particular day and the corresponding return on a stock market index, say the S&P 500. And finally, the risk adjusted returns model, which is pretty much the most superior of the three because it considers risk adjustment. We're going to have to first run a regression of the stock against the market and then find the intercept and the slope and plug them in here. And then the difference between this return and this systematic component of the regression model would represent the abnormal return, which has been adjusted for the systematic risk of the stock, beta. So here's an example which I show on Excel. So here on January 4th, 2016, there's this negative news about Amazon, which you can read on your own. The stock actually lost 6% on this date. So I'm going to use monthly data though, just for fun. All right, and so what I've done here is I went on January 4th. This is the price on the S&P index, and this is the price on Amazon. And then I calculated their rates of return for S&P and for Amazon. But the rates of return I calculate here are actually monthly. So for example, this return, negative return of 14%, 14.10% for Amazon on the negative side is actually the rate of return between this price of $587 in the month of January 2016 and the price in December of 2015. So actually, here's the historical data right here. Right, that's what you see right here. All right. So this is actually the price on December of 2015. So all I did, I used logarithmic form to calculate rate of return. Always good to use logarithmic form, like so. Equal ln open parenthesis. This is the current price for this date. We divide it by the preceding month's price. So we click on this guy right here, and pushing this back up, I close parenthesis, and that's how I got this 14%. So likewise, you calculate the corresponding return on the market. And then for each of these months, you do the same, as you can see right here. So now let's calculate the mean adjusted returns for Amazon. This negative 16.34%, all I did was I came here, equal. Again, look at the formula here. The actual return on this date for Amazon is this guy right here. And I subtract the average return. I already calculated the average return. You can see it right here. I click on that. Right? So, and I hit enter, and that's how I got this. Now, this average return that you see here, look at the formula right here. I just use the average function, and if I hit F2, it's the average function of the monthly rate of return from 2011 to, remember, 2015. So, likewise, I calculated the intercept using the intercept function. If I hit F2, it's the intercept that looks at the regression between Amazon, the blue column, and S&P 500, the red column. You can see it right there. And then finally, the slope parameter. If I hit F2, you see the slope function here. You can also look at it there in a regression between Amazon and S&P. So you can simply use the functions to obtain the slope and the intercept without necessarily having to run a regression. So with that, I calculate with those estimates, I calculate the monthly mean adjusted returns for Amazon. And then for market adjusted return for this particular one here, all I did was equal the actual return on Amazon on this date minus the corresponding actual return on S&P 500. and that's how I get 8.89%. Now though, risk adjusted returns, we're going to have to be careful because again, look at the formula right there. So to calculate this first one here on day 0, I would have to hit equal. All right, and then I click on the actual return on Amazon, looking at this formula, minus the expected return, the mean return if you like, and that mean return is going to begin with the intercept. So I click on this intercept. To that I add the product of the slope, which is this guy right here, and the corresponding return on the market, and this is the corresponding return on the market. I close parenthesis, and just to be sure, I like to, even though my math shouldn't be a problem there because I think my ped mass is all right, but I like to put parentheses around these two and then be sure to put one more parenthesis around here so I can see the logic. Right now, without that, it should still be correct because the multiplication should go first. In any event, that's what it is. I hit enter, and that's how I got this 9.23, which if I format it, you'll see that it's identical. So with that, I calculate these abnormal returns, and you can see that these three methods tell you similar stories. You can see that in the case where there's a huge abnormal return using the market adjusted return, we see similar situation with these other two guys right here. And the pattern is the same if you look down all the way. So that's really it. So right here in the PowerPoint presentation, I summarize the input data, which I've just shown you how I calculated those, and then as well as the summary of the abnormal returns based on the mean adjusted returns, market adjusted returns, and risk adjusted returns. For good measure, for this first calculation here, which I just demoed on spreadsheet, here's the calculation right here if you want to use your calculator. For market adjusted returns, here's the substitution right here. And for the risk adjusted returns that yielded this 9.23%, that's it right here. And this concludes this presentation. I'm Pat Obi, Purdue University Northwest.